Ladies and gentlemen, good day and welcome to the CCL Products India Limited Q1FY25 conference call hosted by Nirmal Bang Equities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhishek Navalgund from Nirmal Bang Equities. Thank you and over to you, sir.
Thank you, Shlok. Hello everyone. On behalf of Nirmal Bang Institutional Equities, I welcome all the participants to CCL Products India Limited 1QFY25 earnings conference call. The management is represented by Mr. Challa Srishant, Managing Director, Mr. Praveen Jaipuriya, CEO, Mr. V. Mohan Krishna, Executive Director, Mr. V. Lakshmi Narayana, CFO, and Ms. Sridevi Dasari, Company Secretary. Without further ado, I would like to hand over the call to Praveen sir for his opening comments, post which we'll open the floor for Q&A. Thank you and over to you, sir.
Thank you, Abhishek. I welcome you all to this conference call. I will briefly summarize the Q1 performance for all of you and then we can open the floor for questions. The group has achieved a turnover of rupees 773 crores for the first quarter as compared to rupees 654.9 crores for the corresponding quarter of the previous year. This is 80% growth. The net profit stands at rupees 71.4 crores as against 60.71 crores for the corresponding quarter of previous year, which is also an 18% growth. The EBITDA is rupees 131.6 crores and the profit before tax is 87.18 crores. The EBITDA growth when compared to the previous quarter of the same, when compared to the similar quarter previous year is 23% and the PBT growth is around 25.5%. The domestic market continued its strong performance and achieved a gross turnover of 95 crores, out of which the brand sales were approximately 65 crores. Balance 30 crores was bulk and private label. We have almost completed and started the launch for the Percol in new packaging and the new product. The product is now available. The new product is available on the shelves, and we are now closely monitoring it. Subsequently, we are now putting marketing activities behind it, and we are looking forward to building the brand in the UK market. So that's a broad and a brief summary of the results. I open the floor for questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rakesh Wadhwani from Monarch AIF. Please go ahead. Mr. Rakesh?
Hello, am I audible?
Your question. Yes, sir, you're audible.
Hi team. Thank you for the opportunity and congratulations for a great set of numbers. Sir, first question with regard to the other expenses as well as the depreciation. We have witnessed a very minor growth or the increase in the other expenses as well as the depreciation has come down. Any reason for that? So, whereas the revenue and the volume has increased by 15-16%, whereas the other expenses have remained constant. Any reason or one of the reason, as well as depreciation, which was 31 crore last year, has come to 23 crore.
Gentlemen, this is Lakshmi Narayana here. Depreciation in Q4 of the last year, we have revised our earlier depreciation policy towards the vending machines. As against the existing life period of 10 years, we have reduced it to the 3 years and it made a provision for 8.16 crores, which is an additional depreciation, which causes the observation of year towards there is a reduction from Q4 to Q1 now.
Mr. Rakesh?
Yeah. The second question with respect to the debt, can you please tell us the amount of gross debt at the end of Q1 and the debt bifurcation of that? What is the debt for the working capital and debt for the capex?
This essentially the increase in debt from March 24 from 1620 crores to 1885. It is purely on account of increasing working capital. So it has gone up from 1,000 crores to 1,200 crores towards the working capital debt increase.
Okay. So 1,200. So just I'm confirming the point. 1,200 crores is the gross debt. Can you just bifurcate the debt for the working capital as well as the capex?
No, it's 1,200 crores is the working capital debt and 675 crores is the term loan debt. Total on 30th June it was 1,885 crores. As against earlier working capital debt of 1,000 crores and almost around 700 crores, which is around 620 crores. So 1620 crores of 31st March 24 has gone up to 1,885 crores.
Okay. Sir, one last question from my side. So can you talk about the volume growth in this particular quarter and how are the clients, that the retailers across the globe are taking, has they started taking the coffee inventory back? Because in the last con call we talked about that the global retailers are running on a very thin inventory levels because the coffee prices have increased. Any update on that? Thank you.
So Rakesh, I answer the second one first. No, there hasn't been, an increase in the inventory that the clients are building up because still the coffee prices are at pretty high levels. So that phenomena hasn't started yet. So that's one. The second thing you asked about volume growth, we are experiencing last quarter around 15 to 16% volume growth, which is in line with the guidance that we have been giving. Despite headwinds, we were able to maintain these kind of growths.
Thank you, sir. That was very helpful. Best wishes always. Thank you.
Thank you.
Thank you. The next question is from the line of Ashish Upalanwar from InvestQ PMS. Please go ahead.
Yeah. Sir, just wanted to understand your thought process on how the scenario for coffee prices is shaping up. I mean, regarding the crop situation around the world, the demand side, and etc.
So this one is a little tough, as we had discussed in the last phone call as well. Things have been very volatile, and therefore the predictability of coffee prices are really, become very, very difficult. So what has happened is that Brazil, last time we had discussed that Brazil seems to be having a good crop. So it had a good crop, but simultaneously there were news and the market suggested that Vietnam had the El Nino effect and they had certain crop shortages. So the prices continued to be very high in Vietnam, which meant that any correction that was probably expected, or let's say good correction, did not happen. So there was a correction in Brazil, but the prices remained high because the availability and the prices in Vietnam were pretty high. So net, things haven't improved drastically. And to add to the, complexities, there has been volatility around. So that's the situation right now. And as we have been telling, most of the predictions for all the market pundits have gone wrong. So we really don't want to kind of give a prediction that how the prices will pan out. But having said so, as we have always maintained, that some of the trigger points are generally the harvesting season. So the next harvesting season for Vietnam and some of the other countries like India also will happen in November, December. So that's the point of time then we will see how things pan out. But that's the situation right now as far as green coffee prices are concerned.
So the next points to watch out would be probably in November when we get the data.
Yeah.
Okay. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Shirish Pardeshi from Centrum Broking. Please go ahead.
Hi Praveen and team, good morning. Thank you for the opportunity. Two, three questions. Can you break down the volume India and Vietnam? And the second question is that if you can break the spray dried and FDC volume.
So, Sirish, I'll give you a little broad area, but let's say that India growth will be closer to 9-10%, and the Vietnam will be a little higher because that's where the capacities were added last year, and that's the capacity that is working. So that is the growth thing between. Just give me a second. I'll tell you the console level what is the GNIG. So let's say I don't spell out the exact numbers, but almost 20%. So 25% of the total volumes will be freeze-dried volumes.
Okay. Second one, follow up on this. What is the capacity utilization in India and Vietnam at this time?
India was minus the food and beverages. So food and beverages, although we started in March, but there the utilizations, a lot of stabilization is happening. So while there is a certain sales that is happening, but the capacity utilization is very not very high. So it will not be more than 5-10% of the capacity. Rest of the capacities we were running almost full. And Vietnam would be, the earlier line. The first line is running at full capacity. The second one probably at around 50% of the capacity.
Okay. And could you spell out some idea on the India branded and domestic business, how it is panning out, what number we have got in Q1?
Yeah. So in my brief, as I mentioned, the India business was approximately 95 crores. And this is growing at an overall level of around 40% right now. And out of this, the branded business is 65 crores, and that business is growing. Branded means the retail business that is growing at around almost 45 to 50%. So that's a little brief. The brands are doing well. We are expanding. The distribution network. We are also expanding most of the channels, right from modern trade to e-commerce. We are now getting pretty strong on quick commerce. So yeah, on all fronts, we are trying to be aggressive and see how we can keep driving this kind of an aggressive growth.
Do you think this year we will be higher of close to about 300 crore, what target we were estimating? The reason why I'm asking because we have done a lot of activation on ground. So maybe if you can help me to get better quality to understand what kind of vending machines we have put in and what is the distribution at this point of time.
Yeah. So, yes, 300 is the number that we are looking at, which will mean that we almost 50% growth over last year. So that's a number that we are gunning, and this is only for retail. At an overall level, the India business should cross 400 crores. And yes, there is a lot of ground activation we are doing, both on the demand generation side and the distribution side. So and there's a lot of, while we do so, there's always, as you know, in FMCG business, it will be an evolution of the distribution as well. So there has also been, last time we spoke about how, we are not only strengthening distribution in terms of number, but also in terms of quality. We are now getting, more and more, and it's a better quality distribution network when I say so, which means that the quality of distributors and the strength of distributors is also increasing by the day. And hopefully by this India, our direct distribution should touch 130,000 outlets. And we are also hoping to drive a lot of indirect distribution through wholesale, which means that we probably, in effect, will be touching around 150,000 outlets. So that's the plan on distribution, and we continue to press upon the demand generation activities, right from ATL to BTL. So all that is happening. We are trying to see are there any other sub-segments that we could enter, and so all that work is happening.
That's really helpful. Just last question on the margin. Though prices are elevated and we have seen a gross margin is decline, and also it had the effect on the EBITDA. Could you spell out if the long-term contracts are now getting revived at the higher price, or what is it that we should look forward for next 2-3 quarters? How the margin will pan out?
So I'll just correct the understanding a little bit here. The margins never contracted. Optically, it gets contracted because, we would work on a per kilo EBITDA margin, which means that if the coffee prices go up, in relation to top line, the margins may look, depleted, but that's not the case. Our per kilo or let's say per tonnage margins are intact. And that's the guidance we always give, that our EBITDA growth will be in line with our volume growth. This quarter, what has happened is that if you're seeing around 23-24% EBITDA growth and our margin growth is 15-60%, there has been a little expansion because this quarter we had certain contracts which were a little higher value contract and more margin contract. So we saw some we saw the benefit of that, and therefore you see a margin improvement, or let's say a kilo margin improvement that we witnessed in this quarter. Now coming back to this question, that are the long-term contracts getting revived? As of now, we are not seeing so much of revival of long-term contracts because the coffee prices are still high. But yes, it seems that as it happens in any commodity, once the commodity sees a peak pricing, there is a period of confusion and then things start settling down. So we are seeing those kind of settlements happening, and we are now seeing some revival, but I would not be too, committal about this fact that a revival has happened. So we'll wait for 1 or 2 more quarters to see how things pan out.
Thank you, and all the best.
Thank you.
Thank you. The next question is from the line of Akhil Parekh from B&K Securities. Please go ahead.
Hi, thanks for the opportunity. Praveen, so my first question is on the coffee prices. If I look YOY, it has almost gone up by 60%, Robusta coffee prices, while QOQ has gone up by 25%. And at the same time, we are saying our volumes have grown by 15-16% on a YOY basis, while sales growth is at 18%. So I'm not kind of understanding it. So is it like we have seen a cut in the pricing in this quarter, one period? Has the product deteriorated?
So, Akhil, there is no cut in pricing and all that. Our model, we go back to that. So a lot of this quarter's contract is actually, contracts which we had done previously. So,
okay.
It will be unfair to compare with current prices. So while the current prices could have gone up by 30%, 40%, maybe 50%, but that really is not the right indicator, because the contract that we delivered is probably, let's say, last year's pricing contract. So in effect, there is not only maybe a lag of 1.5 years also that may come into play. Yeah. So that is why, that comparison is not a right comparison, I would say.
Okay. And so do we still maintain that 15 to 18% of the volume growth guidance for 25, so given that we have already done 15-16%?
Sorry, your voice is getting a bit smudged. Can you?
I'm saying, do we maintain the volume growth guidance of 15 to 16% for this year?
If you remember last quarter, we had given a little broader guidance this time, considering the volatility in prices. We said 10 to 20%, we landed at 15%. But we would like to guard ourselves and say that we still maintain 10 to 20%. I would not be committal at this point of time, because as I was telling you earlier, also long-term contract revival is still not, it's not strongly back. We are still, most of the clients are into hand-to-mouth kind of a situation. So the orders are really coming, not in a long term, but in a very, very short term manner. So we don't have so much of visibility for me to be committed about this. So therefore, I will maintain the guidance of 10 to 20% as of now.
Sure. And on the EBITDA per kg first, do we still maintain that 100 to 110 rupees per kg kind of guidance for next 2 years? Do we see the change because FDC capacity is going to come now on stream in Vietnam? So can we expect improvement on that side?
Again, not really, because as we have been telling you, there are a lot of things that play up. This quarter we got some improvement, largely because of high value contracts, and there are more small packs that we did. But coming quarters, there are some volume contracts, some low margin businesses that will come our way. So we would like to maintain the guidance that most of our EBITDA growth will be driven by volume growth and not really by margin improvement. After maybe 1.5 years or 2 years or so, I think that's the time we will start improving the margin profile as such. And again, it's not an overnight thing. We have always told that we are working towards it, more of small packs, more of branded business, more of high specialty coffee. So all that will happen gradually, but the visible effect you start seeing more like in the, let's say, 1.5 to 2 years.
Okay. And how much would be small packs now as a percentage of total sales, total units?
So broadly, it is at 20%, Akhil. But yeah, there has been an improvement because small packs is also about our own brand business. So overall, the small pack contribution is improving. Still at a 20-25% level, but yeah, we are seeing improvement on this front.
Okay, great, sir. And best wishes with them.
Thank you.
Thank you. The next question is from the line of Rahul Maheshwari from Ambit Asset Management. Please go ahead.
Hello. Hi, Praveen. Just had one question that can you give some color on the client addition that has been taking place in the what kind of clients addition and in terms of the wallet share that has been taking place from the existing clients. And just adjacent to that, the US capacity was running at an annualized, US as a geography was running at 8 to 10,000 per ton, where that as a market has been reached for us. These are my two questions. Thanks.
So, this one is quite granular thing that you've asked. Probably we'll have to go a little deeper here. I'm not sure that I'll give you a lot of color on this. But yes, see, that's an endeavor that keeps happening. We are wanting to increase the wallet share with our clients. And I have always maintained that that's only not just the only thing that we grow on. There are things like new client addition. It's a leaking bucket. There always will be new clients, and there will be clients who will be dropping off from the rooster as well. So all these things are happening. The net effect is what you are seeing as growth numbers. So all that thing, there are certain clients where we have increased our wallet share. There are certain clients where we have probably decreased our wallet share as well. It's a continuous process. I think it's more like, my net, when I say leaking bucket, my entry should be more than my exit. So that's the endeavor that we all work upon. So yeah, that's.
Praveen, but just can you give some qualitative that how the value-added share has gone up? I'm not talking in just one quarter basis, but if you can give us some direction that earlier it was in low single digit where it has reached, and where you aspire to go in terms of wallet share, that would be very helpful.
Right, I'll tell you. So, generally, first I talk about wallet share, and then I break it up for you in terms of value-added products. Yeah. So, wallet share, generally a client will also, because they also de-risk their business, so they will not let a supplier's wallet share go beyond, let's say, 35-40%. Yeah. So, there are clients where we are working on the highest levels of 35 or 40% of wallet share. There are a lot of clients where we are only at, let's say, 5% of the wallet share. So our endeavor is to kind of, get into more of a 20-25% wallet share for those clients. As I told you, we're always on a lookout of new clients. So that's the endeavor on the wallet share, aspect. Now coming to value added. So let's say there are two types of things which are value added for us. One is the value added coffee, which could be specialty coffee. And the second thing is the small pack where we earn more margins. So these are things which will help us improve our margin structure. Our endeavor is to keep hiking the proportions for them. Just to give a little example, and I'm giving a longer period example because then it gives you an idea where we were and where we are going to. Let's say 4 or 5 years, our small pack contribution was in the single digits, probably 5 to 10%. Now it has reached to 20 to 25%. So that explains the effort that we have put in to make sure that we do more and more of small packs, and that's the reason we have put up facility which is helping us do more and more small packs for our clients. Coming to specialized coffee, 3-4 years ago it was maybe not even 1% of our portfolio. Today it is more than 5% of our portfolio. And sometimes we also have a combination of specialty coffee being packed in a small pack. So that is the sweetest spot for us because that gives the best of margin. So we are doing some of those stuff as well. So yeah, that's in brief, how we what our endeavors and how our models are working.
Also, can you give some highlight on the, I don't want specific names, but number of customers that are being added, or what you aspire in any per annum basis? Because generally it takes, as you mentioned, 2 to 3 years to crack a particular customer. So any pipeline or anything which you want to give direction, that would be helpful.
So on a very, very broad basis, in any year, we would add 10 to 15 clients, new clients, yeah. There will be 4 or 5 clients will drop off also. But these are not permanent drop-offs. These are drop-offs could be temporary. But that's the kind of thing that we maintain. And, our endeavor is just not to, adding clients is not the only aspect, because I could go ahead today and offer some, dirt cheap prices and add 50 clients. That's something that we can do anytime. But that's not what we want to do, is add qualitative clients which are of high quality. Not necessarily, this does not necessarily mean that I only want clients with high margin business, but it means that clients who are going to stay with us long term, who have got some standing in the market, clients who are looking to build brands for themselves, because mostly the clients who are building it for their brands are much more stickier business than traders. So these are the things that we keep in mind when we are, onboarding client, and that's been our endeavor.
And your view on US, how the capacity is? It was an earlier question only.
Yeah. So I think there's some confusion here. It was not 8 to 10,000 that we have ever spoken about. It was 4 to 5,000, and that is growing by a healthy rate of 15% volume over year on year. The US market is also challenging. What happens is that right now the Brazilian prices are much lower than the Vietnamese prices. There was a time when things were inverted. At that time we had a little more advantage, so driving volumes was easier. But today it's that much more tougher to drive volumes there, because the Brazilian suppliers are having an edge, at least in terms of, while we not have much of procurement edge, because we can also procure from there, but we do have a logistical edge that they have on us. So, these are difficult times for us to penetrate more than what we have penetrated. But yeah, the endeavor is to keep, nibbling away and seeing that are there any avenues of growth that we can embark upon.
Thank you. Thanks, Praveen.
Thank you. The next question is from the line of Akul Brochwala from Avendus Investment Managers. Please go ahead.
Yeah, hi management. Thanks for the opportunity. First is on, as you mentioned in your opening comments, that this quarter kind of reflects the pent-up demand that was kind of there since many quarters. So do you think that at least the near-term pent-up demand is kind of already catered to, and now customers will only probably wait for prices to go down further?
Yeah, no. So I think it's not demand. I think what we should see it like this. This is more, near-term demand. So what is happening is that most of the customers or clients are wanting to feed their near-term demands and are not committal about long-term, contracts. And the reason is exactly the coffee prices, because the coffee prices are at high, and at high prices, everybody wants to wait and watch, because, everybody is hoping, and this hope has been there for last 1.5 years, because when the coffee prices reached 2,500 levels, people thought that this is the peak. Then it did not stop there. It went to 3,000, 3,500, 4,000. So what is happening is that at every interval, people are expecting that there will be a correction, and therefore what they do is that they only give commitment for their short-term needs, and that's what is happening right now, and that's in the market scenario. Now, when this will invert, we really don't know, because still at this point also everybody is expecting that at some point the coffee prices will correct. So people are in a wait and watch mode still. So let us see how things pan out in the future.
Got it. And like in terms of the debt, so are we already at the peak debt level, of this 1,865 crores, or do you still expect, based on your volume growth, the debt to further inch up even from these levels?
So if we continue the current volume growth, even at current static prices, the debt level will go up. There is no doubt about that. So we're looking to end the year at around 2,200 crores from 1,800.
Okay. And another thing in this,
right now, but let's say if the prices do drop after November, December, then this would come back by a couple of hundred crores. Come down by a couple of hundred crores.
got it. And in the previous call, you did mention that you were looking to refinance that at probably lower cost. So has that already been through, or maybe you're still evaluating that?
No, so we are still under review. There are a lot of background working that has to be done. So we are constantly reviewing it, because what is happening is that the interest rate scenario also across the world is changing by the minute. Yeah. So while we speak, there should be certain interest advantage you may get in some country, but the next day you see things inverting, and we are seeing how the world market is behaving. So that's been an added challenge to kind of take a call on that. So we're still working on that, and nothing of as of now is formed out.
Got it. And just finally, some bookkeeping questions. This depreciation for 1Q, do you expect this kind of number to now be the quarterly run rate for the coming quarters, or there will be some more volatility?
We're working hard towards it, but I maintain the guidance of 10 to 20%, and we'll stay with that, because as I told you, the long-term contracts are a little difficult to come by. They're still short-term, so we'll talk quarter on quarter. And yes, the endeavor would be maintain this kind of a run rate, but I'll still not give a firm guidance of this run rate.
Okay, and the tax rate for the full year?
Sorry, did you ask tax rate?
Yeah, just wanted to check your guidance for tax rate for the full year.
13 to 14%, I think, at a console level.
Okay, got it. Thank you, and all the best.
Thank you. The next question is from the line of Parth Agarwal from Bastion Research. Please go ahead.
Hi, thanks for the opportunity. My first question is that since we have already launched the coffee brands in Europe, so I just wanted to understand what is our strategy to gain the market share in that region.
So we have launched it in the UK market. Now the strategy is very simple. This brand that we had bought there, Purple, has been known as a brand which cares for the environment. It was for the environment friendly, audience who cares for the environment, certified coffee and things like that. So we are building upon that proposition. And what we are also doing is so right now what has happened is that, UK market is largely modern retail. So our endeavor is to get it listed, because what had happened in the past 3-4 years, this brand had got delisted from a lot of chains. So our first endeavor is to make sure that we get the listings. The first proof of pudding would be that in the stores that we are listed, once the offtake improves, then it gives us time to go to other chains and say that, look here, things are improving upon us. And that will happen because of our efforts that we are doing, both ATL and BTL. So we are looking to, do social media awareness building, some localized activity awareness building, which will help us gain traction for the brand. We are also looking to tap into some of the newer formats there. So there are things like coffee bags and all that, which are gaining traction as a format in markets like UK. So we have already launched the formats, purple formats in coffee bags. Now that is something that we are also looking to push forward. So all of this we are trying to do to make sure that we gain the momentum that this brand had a few years ago.
Got it. So all the manufacturing that is happening for this brand is from India, right? And we export it from here.
All the instant coffee is happening from India. All the roast and ground, like I talked about the coffee bags and all, which is roast and ground format, which we are doing third-party manufacturing in UK itself.
Okay. And also, can you help me understand the Swiss subsidiary business? So I understand that it's an agglomeration plant and that you have positioned it as an agglomeration plant in Swiss. But what is the purpose it's solving there, and why can't we directly export it from India or Vietnam?
There are various purposes it solves. The biggest purpose that it solves, it helps us to be nimble-footed in the market, because if you see Europe is, there's very small countries, there are a lot of small clients who are there who want coffee, their demands could be immediate in nature. And when you are, trying to fulfill those kind of demands, it becomes very difficult to export from India and, fulfill those demands. So these kind of arrangements helps us, service these demands and grow our business. And these are very profitable business because these come from, chain of supermarkets. These could come from small brand owners. And these businesses, while they are small in nature, they aggregate into a good profitable business. So that's the reason it helps us to be there in Switzerland.
Got it. And the current capacity there is for 300 metric tons for agglomeration, right?
And that's only an agglomeration capacity. So anyways, that's not a processing unit. So anyways, the base product goes from India only. And depending on the client's requirement, if somebody requires agglomerated product, we agglomerate and give it there.
Got it. And just one final question. So I understand Continental Coffee Private Limited, that's wholly owned subsidiary that we have, is into food and beverage business. Can you just detail out what exactly does that business do currently?
So basically what we did was, last year, if you remember, we demerged the back-end business back to the parent company. And we said that that entity will be only used for our retail endeavor. So we already were running, our Continental Coffee kiosks at certain places like metro station and a couple of them at colleges. Now we have evolved that format and we are going ahead with a full-fledged cafe. We just opened a couple of them in the last month at Hyderabad. We'll do a POC. If we feel that concept is working for us, then we will kind of look forward to expand it. How will we expand it? Where would the capital come from? And all that questions we'll answer once we understand the proof of concept.
Got it. That's all from my side. Thank you.
Thank you. The next question is from the line of Bhargav from Ambit Asset Management. Please go ahead.
Yeah, good morning, team, and thank you for the opportunity. Sir, any comments on market share, given that we managed 15% volume growth in our top market?
This one is a tough one because generally market share, there's no syndicated data that comes telling you what is the global market share that you have. And capacities on a very regular basis are getting added, deleted, and things like that. But, when we triangulate data, we had said that when we were at, 44,000, or let's say around 40,000 metric tons, we probably were at around 6-7% market share in the world B2B market, the addressable B2B market. And then we said since the market is growing by 2-3%, and we probably are looking to grow at 17-18% at a CAGR level for next 3-4 years. Our guesstimation was that we probably will end up at around 12-13% by 27-28 kind of by 27-28. So that's the scenario right now. But these again are you'll have to take these numbers with a pinch of salt because these are all triangulated data and not any syndicated data that we have to refer upon.
Sir, on the share of freeze-dried, you mentioned 25%. So can this increase post your 5,000 ton capacity getting added in the second half?
Probably not. There are two things. In terms of capacity, while that 6,000 tons is added, we also got an India spray-dried capacity of 15,000 tons, which has got added. So probably it remains in the same proportion. But while I say so, this is on the capacity front. A lot will also depend on the market demand front. So let's say if the demand for freeze-dried increases, then probably the proportions could increase. But difficult to comment just because of the capacity. I don't think so that should be the driver for our big number.
And in terms of price hikes, is it fair to say from 2Q onwards we would have taken price hikes as well compared to 1Q?
So our price hikes are generally related to the green coffee prices because we work on cost-plus model. So it will really depend on the green coffee prices, how they move. And that will actually determine price hikes for us.
Okay. And last question is on the profitability for the branded business. Is it possible to share?
No, so yes, of course, we last time itself we said that we had broken even and we probably will be looking to get to a 7-8% EBITDA margins for the branded business.
In this year?
This year, yeah.
Okay, great, sir. Thank you and all the best.
Thank you. The next question is from the line of Devanshu Sampath from Avendus Capital Private Limited. Please go ahead.
Yeah, hi, good morning. This is Anirudh here and Devanshu. I have two questions. One is as far as EUDR compliance is concerned, could you tell us what proportion of the coffee that you're getting would be compliant, and is that a risk as far as continuity is concerned post-December, and is there a chance that these regulations may also be pushed back if some color can be provided? And the second one is that in terms of timeline of the new capacity startup in Vietnam, we are on track on September, October. I just wanted to clarify that.
Okay, yeah, so we are on track. September, October, we should be up and running. That's on the capacity. On the EUDR, I think there are 3-4 angles to it. One is that, Indian coffee, which is generally shade grown and is grown in the jungles and all that, they are fully compliant with EUDR. Second thing is, this is largely for the commodity itself, green coffee. Instant coffee does not come under this ambit. So I don't think so there is any, right now, as of now, there is no risk that we see on this front.
Right, thank you. Just one follow-up question, one more data point actually. What would be your current cost of debt, both more importantly, the incremental working capital debt is, what is the average cost currently, please?
So, till June, it was around 600% average cost of funds towards the working capital, and it is likely to go up to 8.25% from this quarter.
Sorry, you said 8.25%?
8.25% is the current cost of funds towards working capital. That is from July onwards.
Okay, from July onwards is 8.25% on the entire working capital debt of 1,200 odd crores.
Right, and yes, you are right.
And this 1,200, is benchmarked to, when you mentioned that this debt could go up a little bit towards the end of the year, this is assuming coffee prices remaining at about 4,000, or at what level broadly?
It is somewhere around 3,600 to 4,200.
3,600 to 4,200. Thank you very much. Very clear. Thank you.
Thank you. The next question is from the line of Disha Giria from Ashika Institutional Equities. Please go ahead.
Hi, team. I just wanted to understand more about the branded business in India. So you did mention that there was a 40 to 45%, 40 to 50% increase in the branded revenue. And what would be the volume growth for the same? And also, how do you see, like, the coffee prices are volatile. For the B2B business, we have a cost plus model, but how do you see it in the B2C business?
So two things. One is that you asked about volume growth, which is approximately 30% or so that we are achieving for the retail branded business in India. And coming to the second part, you know how FMCG works. There are different pricing things here. We can't work on cost plus. Generally, because we are a fighter, we are a competitor to the larger already established player, we maintain a pricing index of the market. So that's how we increase prices, and we have seen 30% or so price increases. But again, there are a lot of challenges here because you can't increase prices on every pack. There are certain packs which are more price elastic, so you can increase more prices there. There are certain small packs and the very small packs like the coinage pack as we call them. Their price increases are very difficult. So we work on driving more and more efficiencies to keep or maintain the margins there. That's how the pricing decisions are happening in the retail B2C business.
So the Continental brand is, I believe, catered to more to the southern part of India, where I think they are ranked second or third. So do you plan to expand this brand within India further?
Yeah, absolutely. So you're right. We started with South India. A lot of our efforts are here. We have gained quite a bit of traction here. And now we are expanding to other parts of India as well. So in fact, the work has already started, both in terms of driving distribution and also generating demand. So there are key markets, and we are typical in the rest of India. It is a far more urban product than what we in South India. South India, the penetrations are much higher. So we are looking to penetrate first the 5 lakh plus population town, and those towns where we feel that the coffee consumption is higher than the others. So a lot of work has already started, both in terms of brand building and distribution expansion. Today, as we speak, we already are covering approximately 1,000 to 1,200 outlets in metro towns like Delhi, Mumbai, and 500, 600 outlets each in the second tier towns like Lucknow or Chandigarh, Indore, Pune. So that's how we are expanding the rest of India.
All right. Thank you. That is it.
Thank you. The next question is from the line of Lokesh Manik from Vallum Capital. Please go ahead.
Hi, good morning, team. My question was on the inventory days, which have, historically hovered around 90 to 120 days, which has shot up to about 180 days for 2 years now, past 2 years. And this is, having an implication on the interest cost, which has shot up significantly. So, any comments on how we are planning to manage this inventory and bring it back down to 120 days, given that we are not, compensated by the end consumer for the days that we are holding the inventory in our contract pricing?
Couple of things here. A lot of our inventory management is dependent on the market scenario, and why do I say so? Because if you see in the last few quarters, our buying from sources like Brazil has increased because there the prices are, lower than the Vietnamese coffee prices. So which means that it adds to the logistics timeline, and therefore your inventory or let's say the working capital cycle goes up. Now, you are right, it adds to the pressure of finances in terms of, interest cost and all that. But having said so, this is our model. So in the sense, because I am getting it at a lower price from Brazil, I am able to earn margins and I am able to sell as well. So that is something which is probably unavoidable. The only thing that I would like to mention here is that all this inventory build-up, or let's say even if the increases are happening, it is for confirmed contracts. So all the working capital that we utilize, not a single penny is utilized for inventory build-up. So these are all confirmed contracts. Yes, it adds to the pressure, but on the other hand, it also adds to my operating margins as well. So whether you see it from this angle or that angle, it actually works out to be the same. Because if I were to kind of, squeeze the payment cycles and all that, I would end up earning lower margins. So I think net, that's a balance that we try to maintain. Now, when do we see these improving? Of course, since our operations are here in India and Vietnam, we see this improving if the Vietnam coffee prices soften. So that is something that we will expect to happen by Q4 or so. So till then, we'll have to stay put with these kind of working capital cycles.
Fair enough, Praveen, but our contract durations are reducing, like you mentioned earlier. We're not getting long-term contracts. So in this scenario, then shouldn't we see, a fall in the working capital cycle because your buying is linked to the contract that you receive on the day, the raw material purchases?
Not really, because even if I get long-term contracts and I buy coffee, I don't keep the inventory with me. So it is a staggered, when I bought today, but dispatches are staggered. So that's how the markets work. So I don't necessarily build more or less inventories because of the short-term or the long-term contracts.
Okay, understood. That's it from my side. Thank you so much.
Thank you. The next question is from the line of Bhavya Sonawala from Samasa Capital. Please go ahead.
Hello, thank you for the opportunity, sir. Am I audible?
Yeah, Bhavya, you're audible.
Yeah. So just a few questions. In our current Continental coffee portfolio, just wanted to understand, do you see any new product additions going ahead, or will we keep it the same and kind of focus on increasing distribution?
Right now, we are focused on largely on distribution, because if you see our share among handlers that's pretty much higher than the average share in the market, which means that there is a demand which I need to fulfill. So the distribution expansion is our key focus right now, and we'll keep building on. The thing is that we ourselves, if you see our portfolio, we probably have a portfolio which is larger than the leaders in the market. So we have always been accused of not giving enough focus on some of these brands. So we'll rather, keep focusing on the brands that we already have. So I don't see a major addition right now. But yes, on the background, we keep working on things. We are seeing if there are some trends emerging that we could capture in the future, especially in the premium segment, in the specialty coffee segment. So we are keeping a watch, doing some product development, concept development. Let's see how they pan out, but nothing in the immediate future.
Okay, understood. Makes sense. Just last question. On your overall business, is it possible to give kind of a breakup based on volume in the top 3 or top 5 geographies that we supply to, if that's possible?
Yeah, so I'll give you a broad indication. Let's say out of our total business, approximately everything put together, 40% comes from the Asian markets, and then around 20 to 25% from East European markets. There will be another 15% or so from the West European and the UK market, another 10 to 15% from the US markets, and the balance is spread between South America, Africa, and Australia, New Zealand. So that's a broad, concept. We are pretty well spread out in terms of geography.
Understood. And just a follow-up, if I were to ask you, in the last 3 to 5 years, has there been a particular geography that you have seen growth surpass other geographies?
If not surpass, yes, there are geographies like North American geography. We have seen a growth. We used to be very small there. Now we are substantially big there. So that's a geography that has done well for us. We are already very good at Eastern European countries. We are now looking forward to see if we could strengthen our presence in the East Asian, Southeast Asia, India. We are very strong, but we are wanting to build our strength in the Far East Asian countries. So this is how we are, building the geographies for us.
That's understood, sir. Thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Omkar Arora from Eraya Capital. Please go ahead.
Hi, good morning, sir. Thank you for the opportunity and congratulations on a good set of results. So my only question is, coffee prices, they have been in an upward trajectory for a long time now. So do we see smaller players shutting shop in this case? And do us as a company see this as an opportunity for consolidation in the space, especially at a time when we are increasing our capacity by so much?
So actually, at an overall level, very specifically, I will not have a huge indication on this. Generally, it happens whenever the commodity prices are at such high levels, there will be consolidation because it becomes so difficult. All of us are stressed about our balance sheet, come to think about the smaller players. So they find it even more difficult. And we are seeing certain things in these scenarios. We also start getting calls for, acquisitions and mergers for smaller players. So there is a trend that is seen, and sometimes it does work as an advantage for the larger players. And we are seeing this trend that it should happen, not just because of higher coffee prices, but because of the scales and the economies of scale that set in. The larger players will get consolidated over a period of time. Apart from that, there is also a trend that 20 years ago you would have seen that the brand owners and the manufacturers were the same guys. Now people are kind of there's so much of segregation that has started to happen. The brand owners are getting separated from the manufacturers. So all that will lead to aggregation, and that should help larger companies. So you're right, that's a trend we are seeing. But how much of that has happened, difficult to comment.
Okay, sir. Thank you.
Thank you. The next question is from the line of Richa from Equity Master. Please go ahead.
Sir, thank you for the opportunity. So my question is, when we are planning to set up FDC capacity in Vietnam, I think the commentary was that, there were committed capacities booked and, there was high demand. So has this scenario changed, and does it change your outlook for what the ramp-up and offtake could be like? And what is the capex likely to be incurred this year? And the related question is, what is the delta between realization margin for FDC and spray-dried coffee?
So I'll just answer the first question, and I'll ask CFO to answer the capex question that you asked. So yes, there is a certain amount of underwriting that happens in certain cases, and that helps us decide our capacity. So that scenario hasn't changed. So that remains intact, and there is no change in outlook on that front. Now, as far as capex is concerned, 15 million this year, how much?
No, total it was scheduled for 50 million total implementation of the project cost, and this predominantly that part of the loan has been availed in last financial year itself. And we have incurred almost around 47 million so far, and the balance is going to be incurred in another couple of months. And by September end, we are going to complete the project and start the operation.
Okay. And sir, will you also comment about the delta in realization and margin for FDC and spray-dried?
There is no delta realization. The freeze-dried margins, as we have told earlier, approximately 30-40% higher than the spray-dried margins. That will remain intact. So there won't be. Now, how does the proportion change as a group? We'll have to see, because if the proportions change from here, then probably at a group level we'll see better margins. But if the proportion remain intact, and our sense is that it will remain intact because we build capacities in freeze-dried, we have built capacities in spray-dried as well. So I don't see much of a change in blend that is going to happen. So our overall margins guidance remains same for the next couple of years.
Okay. And sir, once we are done with this capex, we would have around 76,000 ton kind of capacity. What is the maintenance capex likely to look like?
So we don't have so maintenance, there will be spares and maintenance that is there, which comes as a regular expenses. I don't see a significant capex there for maintenance that is going to happen.
Okay, thank you, and all the best.
Thank you. The next question is from the line of Romit Nagpal from Terrapolis Assets Private Limited. Please go ahead.
Hi, good morning. Just wanted to check, there's been a lower depreciation this quarter compared to the previous quarter. Any particular reasons for that?
No, so actually this is not lower depreciation. Previous quarter was normally high because we had changed the life cycle of our vending machine when the domestic business got merged into the parent company. So from a 10-year we went to 3 years, which led to 8 crores of higher depreciation last quarter. So if you see previous quarters, it will be very similar to this quarter.
Thanks. Given that we work on a cost-plus model, and I've been tracking the company for years, and given the current quarter that's gone by, assuming some fluctuations because you mentioned earlier regarding short-term demand and not really long-term contracts, does a PBT in the range of 320 to 350 crore for the year sound reasonable?
PBT of 320 to 350 crores sound reasonable as of now. But we'll build upon that, probably next quarter we'll have a little better picture because things are still volatile.
Given that the tax rate is moved up, what tax rate should we assume for the year?
At a console level, around 14%, 13.5-14%.
And you had a 20% increase in top line. How much of this is driven by increased volumes?
Around 15% in volumes.
Okay. Thanks a lot. That was all.
Thank you. Ladies and gentlemen, due to time constraints, this was the last question for today's conference call. I would now like to hand the conference over to the management for closing comments.
I thank you all for joining the conference with us. We look forward to interacting again the next quarter. Thank you all. And thank you, Abhishek and Nirmal Bang for doing this call. Thank you.
Thank you, sir. On behalf of Nirmal Bang Equities, that concludes this conference. Thank you for joining us, and you may now disconnect.